People love asking about which individual stocks to pick, or if they should jump into crypto. But worrying about shiny top-floor assets before securing your baseline is like trying to install granite countertops while your foundation is sinking into the dirt. Look at this diagram to see the math problem. If you earn an 8% return in the stock market, but carry credit card debt charging 22% interest, you're losing money. Your gains are instantly draining out through a massive leak. Building real wealth requires stepping away from speculative bets and submitting to a rigid mathematical sequence. There is a precise order of operations to capital allocation. When you skip the foundational steps, personal finance stops being a reliable engine for compound growth and turns into a mathematical gamble you are almost guaranteed to lose. The first step is the emergency fund. This covers a broken transmission or an unexpected medical bill, but more importantly, it provides the psychological safety net that keeps you from making terrible financial decisions when life throws you a curveball. Research shows that people with at least $2,000 in emergency savings report financial well-being scores 21% higher than those without. It buys you the peace of mind to focus on the next step. Once you have that cash buffer, all extra capital must hit the debt avalanche. This means targeting any consumer debt carrying an interest rate above 8%, attacking the highest rates first. This chart compares the historical 8 to 10% average return of the S&P 500 against the 22% average interest rate of credit card debt. Every dollar toward paying off that 22% debt yields a guaranteed 22%. When we add Warren Buffett's long-term average return to the graph, the reality becomes clear. By aggressively paying down high-interest credit cards, you mathematically outperform Wall Street's greatest investors. Eliminating that debt removes a massive liability, transforming your monthly payments back into free capital that you can finally use for actual growth. There is exactly one mathematical exception to the debt avalanche rule. Before you throw every single dollar at high-interest debt, you must capture your employer's 401k match. If your employer offers a dollar-for-dollar match, every unit of capital you invest instantly duplicates. That is an immediate, risk-free 100% return. But the goal here is precision. You contribute exactly enough to capture the maximum match, lock that money away, and ensure every remaining dollar is redirected back to destroying high-interest debt. You do need to check your company's vesting schedule, which determines exactly how many years you must remain employed to legally keep those matched funds. Even with vesting requirements, the math is undeniable. Leaving an employer match on the table is leaving free money behind. With debt eliminated and the match secured, your capital enters the tax optimization zone. This is where investors shelter their money in specific accounts to legally avoid IRS drag, allowing compound growth to do its heavy lifting. First, you want to fund an individual retirement account, or IRA. Unlike corporate 401ks, which often force you into a limited menu of expensive mutual funds, an IRA gives you total control to buy low-cost index funds. This saves you thousands in management fees over a lifetime. Next is a tool most people completely ignore, the Health Savings Account, or HSA. For those eligible, it is perhaps the most powerful investment vehicle available. An HSA offers a rare triple tax advantage. Contributions go in tax-deductible, compound in a tax-free vacuum, and medical withdrawals come out tax-free. Invested over 30 years, you could accumulate over $400,000 for healthcare costs, completely untouched by taxes. Once the IRA and HSA are maxed out, you return to your employer's 401k and increase your contributions up to the legal limit to shelter as much of your remaining income as possible. Moving your money through this exact sequence shields your capital from annual taxation, giving compound interest the optimal environment to accelerate your wealth. This system is incredibly boring. There are no hot stock tips or panicked reactions to headlines. It is a quiet, automated process that works consistently in the background. We often confuse rich with wealthy. Rich is the expensive car and the flashy lifestyle. Wealth is invisible. It's the money that hasn't been spent, the space you create by keeping your ego smaller than your income. The heaviest lifter in this entire blueprint is time. Look at Warren Buffett. Considered the greatest investor alive, over $150 billion of his net worth came after his 65th birthday. Consistency matters far more than finding the perfect trade. Your financial goal shouldn't be beating the S&P 500 or making a spreadsheet look impressive. Money is a tool to buy independence, flexibility, and a good night's sleep. When you execute this unyielding sequence, you remove the guesswork. Financial independence is no longer a matter of hoping you get lucky in the market. It becomes a mathematical inevitability.